short $8.4 billion of credit default swaps related to mortgages or financial companies. And I was extremely confident in the outcome.
Were your investors as confident?
I know for sure that some of them thought I lost my mind.
Did you know Michael Burry sold big stocks like Google, Meta, Bristol Myers Squibb, Discovery Inc., and Warner Brothers, among others, and replaced them with a stock called Geo Group? Well, neither did I. Burry has become one of the most talked about investors in recent months. He's sparked countless discussions through his thoughts and opinions about the state of the economy. It's fair to say that Michael Burry's opinions recently haven't been very cheerful. For the past few months, he's constantly hinted at a big stock market meltdown and feels we're not actually even in the heart of the burning hell yet. But, perhaps more amusing than his tweets, Michael Burry, as an investor with over $100 million in assets under management, is required to make a 13F filing every quarter, revealing what he's doing with his own portfolio. Stick around until the end of this video to find out what Michael Burry's portfolio looks like now. Here are 3 major points that'll help you understand Michael Burry's outlandish investment moves. Number 1. Michael Burry's prediction. Over the years, Michael Burry has built a reputation for himself in the investing world and beyond, as his bet on the subprime housing market crisis inspired the movie The Big Short. Many investors follow Burry's portfolio changes because of his foresight and the added fame he received from the movie. In recent months, Michael Burry, the Eternal Bear, has tweeted about how he was right about inflation, how the market was destined to fall off a cliff due to the Fed's mismanagement, and how it's going to get a lot worse than anyone expected. But the market has risen significantly. Michael Burry has since deleted his Twitter profile, but we do have some stuff that he said. The S&P 500 is currently up roughly 17% from its June low, which would ordinarily drive many Mayday forecasters to go back into hiding. But we're not seeing any of that from Burry. He's rather doubling down on his prediction that the stock market crash will be a lot worse. He's called the current market performance a short-term bear market rally. Michael Burry has highlighted the similarities and bounces during the tech bubble crash and now. On the 11th of August, he tweeted, "Nasdaq bull market because it's up 20 off its low. Who makes this stuff up? After 2000, the Nasdaq did that 7 times as it fell 78 to its 2002 low." On August 15th, he added to that reasoning, saying, "The S&P 500 completed a 22% 2-month rally, and the Nasdaq a 43% rally. The S&P would fall another 42% and the Nasdaq another 48% by the bottom post-WorldCom in late 2002. Look at the news article he attached to that tweet, which is from May 22nd, 2001, about a third of the way to the bottom of that crash. In that article, an investment strategist, Brian G. Belsky, said they feel the bottom is in place. Investors, in general, know that they have to be aggressive to try and buy back tech stocks in particular ahead of the positive news. Or try this. Larry Washtel, a market strategist at Prudential Securities, said, "It's just a classic case of anticipating events out into the future." Well, those dudes were destroyed, but it's fascinating to compare that sentiment to today, since a lot of the news pieces I'm reading now imply that the worst is over and we're simply returning to a bull market. By the way, are you enjoying this video? Then please give it a like and hit the subscribe button if you like content about business, economy, and crypto. It really helps me to grow the channel. This brings us to point number 2, 13F filings. Michael Burry obviously disagrees with the bull market narrative, and his most recent 13F filing backs up his words. And for those wondering what a 13F filing is, it's just a file made by major money managers 45 days after the end of a quarter that reveals to us their stock portfolio at the end of the same quarter. So all the big shots like Warren Buffett and Charlie Munger, Bill Ackman and Carla Khan file one, as does Michael Burry. And you know what? According to Michael Burry's 13F, he sold out practically every single position he held at the end of the first quarter. At the end of the first quarter, he held 11 big stocks like Google, Meta, Bristol Myers Squibb, Discovery Inc., and Warner Brothers, among others. He even had a put option position against Apple, but at the end of the second quarter, all of those holdings had been cut, and he only replaced those with a very small new investment in Geo Group. He's been saying for the previous 3 months that the market is headed south, So if he truly believes that, it makes sense that he's liquidated his assets and returned to using cash. And his actions actually resemble his opinions, which is way more than we can say for a lot of the investors out there. Number 3. But what does this mean for everyday investors? So I've heard from a lot of folks recently who are selling down their portfolios because of Michael Burry. Check out these headlines. Michael Burry is selling everything. Should you? Mr. Big Short Michael Burry makes a shocking decision. The media often fearmongers, so it's quite obvious why a lot of people get wrapped up in anxiety and look to sell. There's even a Twitter account gaining popularity right now called Michael Burry Stock Tracker, with around 63,000 followers promoting the idea of merely copying the trades that Michael Burry makes. But I don't see the logic behind tracking and copying Burry's moves, because here's the thing about Burry's 13F filings. As an investor, you can't really take anything away from them because, while being value-minded, he's not always focused on the long term. The problem lies in the fact that he's not even focused on the medium term. His holdings are almost always focused on the short term. And the only time 13Fs are valuable to investors is when the mega investor in question is investing for the long term. Why? Well, keep in mind that the 13F filing only shows us a single image of the portfolio at a specific point in time, such as the close of business on March 31st or June 30th. If you're following the 13F of someone like Michael Burry, the portfolio could change up to 8 times between those dates, so the data you do get as a long-term investor could be jam-packed with misleading signals. Burry may well have acquired those Apple put options on March 31st and then sold them on April 1st. For instance, despite getting the 13F filing only recently, there's a high possibility Michael Burry no longer owns Geo Group. Unfortunately, it's true that 13F data from people like Michael Burry means very little in the bigger picture of things and shouldn't actually be acted upon. Imagine if you followed Michael Burry when he bought Meta on the 16th of May 2022. When his Q1 filing was made public, you'd probably be a little concerned now that a Meta had fallen roughly 13 to 14% since that time, and now, on top of that loss, you've got the news that your mate Burry has now sold the stock just as quickly as he bought it. And now you're in trouble because you copied the heck out of Burry's moves. This is why, while looking at the 13F filings of someone like Michael Burry, you should take them with a dose of caution. 13F filings are still great sources of information, especially if you follow value-oriented long-term investors like Warren Buffett. Changes in 13F filings are quite intriguing in those cases. The data is likely to be absolutely valid by the time it reaches you, and for many years to come. I mean, take a peek at Warren Buffett's portfolio history via his 13F filings. Q1 filing from 2021 is almost similar to this year's Q1 file. Look at Buffett's top 10 stocks to see how consistent his holdings have been over the last 3, 5, and 10 years. Very little changes throughout that time, and when anything does, the changes are usually everlasting. So what ultimately matters? What really counts in today's markets are the monetary and fiscal postures of the world's central banks, particularly the Federal Reserve. Monetary easing has the power to reduce the consequences and implications of certain macroeconomic conditions and valuations. Yardeni Research Incorporated presents an informative figure that compares the S&P 500 to the total assets of major central banks. According to the statistics, central bank assets have been decreasing with the S&P. In June, the S&P 500 was falling faster than bank assets. Stocks have recently recovered and are now on a level with bank assets. If assets continue to fall, it's likely that equities will soon follow. But what about you? Do you agree with Michael Burry's short-term vision? Or are you a long-term kind of person like Warren Buffett? Let me know in the comments below. If you enjoyed this video, make sure to watch our previous video about Michael Burry's predictions. And don't forget to click that subscribe button. I make videos like this every week where I uncover the secrets of money and business.